Good afternoon, everyone, and welcome to today's Yellowstone Advisory webinar with Simon Young, a professional fund manager of over 20 years experience. He's worked at institutions such as BlackRock, Aviva, and AXA Framlington. I've had the pleasure of knowing him for almost 20 years. He was a client of mine in my stockbroking days, and we worked together when we set up an investor relations business a few years back. It was a great period of time. So Simon, welcome to us today.
Hello, Alex. Hello, everyone. Thank you for joining.
Brilliant. Simon's been running the AXA Framlington UK Equity Income Fund for the last 2 years. In that time, the fund is one of the top performing funds in the equity income sector. So congratulations on that, Simon. And perhaps as a starting point, before we get into the fund itself, perhaps you could tell us a little bit about how you got into fund management.
Sure. I mean, for my family, it was all they're all medical. So my dad, my mum, my dad's two brothers, and my brother is now also a spinal surgeon. So medical path was the path of the family, but it wasn't for me, especially after I nearly fainted, I think, when I saw a little boy fall down a tree and slice his leg open quite badly. And when you don't like blood, that's not particularly good direction to go in. So, you know, I did a paper round when I was 10, and the newsagent used to talk about shares a lot, and that piqued my interest. But I certainly wasn't one of these people that bought their first share at, I don't know, 15, as you read about some people. But I was interested in finance, and I was lucky enough to have the milk round where they used to come and present their companies to you at university. And I thought, oh, this finance looks really interesting to me. So, you know, I got the opportunity to do an internship, or not quite an internship, did some holiday work at British American Tobacco in the finance department. And so I was lucky enough to get a job at Mercury Asset Management in 1997. Which was a FTSE 100 company, which had been spun out of SG Warburgs, and it later became BlackRock. So I was there for 17 years. You know, that taught me a hell of a lot about investing, company analysis, spreadsheets, going to company meetings, going to visit companies. And, you know, that was a really good formative base. I spent a couple of years after that at Aviva, and that didn't really work out for personality reasons than anything else. And then you and I started a company together, which was that I would say that I learned a massive amount about business. And I have a lot of respect for entrepreneurs out there who start businesses from nothing. You know, we did it on a shoestring, and you know, I'd like to think that we learned a lot of lessons about when you get paid as companies, and who owes you money, and how quickly you get paid. But yeah, and I've taken some of those learnings into my current job that I started in September 2018 with AXA Framlington, where, as you say, I run the UK Equity Income Fund.
Yeah, and you know, when we worked together, I knew that you were incredibly passionate about stocks. You're incredibly passionate about investing. And I wondered if you could just enlighten us as to what is it really about the job that you enjoy, and why is it that makes you so passionate?
Yeah, it's an interesting one. Investing, in some ways, there's no physical end product. If you're making cars, at the end of the day, you've made 500 cars, then you can point to that and say, I've made that. And my brothers, my dad, they do operations. They could say, I've literally healed that person, and that person is going to have a better life as a result. And so at first I felt that I was a bit disappointed, you know, when I was very young. But actually, the more you look at it, the more you realize there is a tangible end product. You know, done right, our job can make people have a better financial outcome than they had previously. So we can help them save for retirement, or save to purchase a house, or save to buy something, you know, through their investments. And that is, I think, actually a great product. So, you know, that's what we aim to do. What do I enjoy about the job? I love the the sort of mosaic that you have to build up around companies, whether it's, you know, adding little pieces of information to a huge board every day. And some piece of information will improve your understanding of a company. Other piece of information will very much challenge what you know. And it's about, I guess, just following the thread, the investigational side of it. You know, we get so much information these days, whether it's RNS announcements on a daily basis, Google searches, looking at job boards, you know, Trustpilot scores. I saw a great piece of information from someone on Twitter the other day, looking at a job board, you know, saying this company is clearly expanding and they are looking for a number of new people. And that was just a really good eye-opener, you know, another piece of information to the mosaic. You know, then there's meeting management, which we do a lot of in my job, but also as importantly, talking to their competitors. So what can you glean from a competitor who says, well, their pricing's a bit funny at the moment? And, you know, there's a lot of insights from social media these days that you just wouldn't have got in the past.
So it sounds like, I mean, you take information from lots of different sources, including, I guess, some of the non-traditional sources. What do you think of Twitter? Is that something you use? And, you know, who would you follow on Twitter?
Yeah, Twitter, as you know, I think is an amazing treasure trove of eclectic opinions, some utterly rational, some completely irrational, and it's about sorting the wheat from the chaff in that respect. That you know, I just was noting down you know, some of the sources that I and my colleagues use, and there's some really balanced and intelligent private investors on Twitter who give some really interesting viewpoints. And I'm not endorsing these by saying them, but I'll just give you an idea of some of the people that I think come up with some of these interesting opinions. You know, there's Rhomboid One, I think his name's John, and Leon Boros, obviously. There's Wheelie Dealer, who's Pete, and then there's Pete, who's Conkers. The Aston Girl, the Stock Whittler. I mean, there's just a raft, and there's David Stredder. There's a sort of raft of these people, Graham Neary, who come up with some really interesting things on Twitter that you, I think, can use to your benefit, especially if you're learning about investment. I think some of these people will post, for the main part, not always, obviously, you know, all things being equal, some very intelligent pieces. But then you've also got the wider internet, whether it's professionals like Morgan Housel at the Collaborative blog, and he writes some brilliant pieces of work there, really interesting. Muddy Waters on some of the shorts has been fantastic, and you know, some people say, well, don't like shorters, but some of the work they've done has been first class. Ian Castle at the Microcap Club, you know, and then you've got some of the bit longer term investors, Jeremy Grantham at GMO, or Howard Marks, who writes about the credit markets from Oak Tree Capital. There's huge amounts of data there that is very much at the professional end, but written for the wider, you know, for the average person. And then podcasts. You've got the Twin Peaks podcast, and then you've got Patrick O'Shaughnessy at investorfieldguide.com. I mean, these are just really interesting and free resources that you can access as a private or even a professional investor. And I think you'd be mad not to. You've obviously got to hold your nose and in some respects on certain parts of Twitter, because there are some, it's unregulated as far as I can work out. And there are a lot of people who do make spurious claims, but for the most part, you can sort the wheat from the chaff. There are some real interesting people to follow.
So it sounds like, as I said, you take your information from lots of different sources, but when you're looking at a company, what are the criteria that you look for that help you decide whether you want to invest in that company or not?
So as I said, I started in 1997, and looking back, there's been one crisis after another. I mean, they're all similar, but different. And, you know, I'll just, in 2 seconds, we had the Asian crisis in 1997, when we had the Thai baht and the Malaysian ringgit currencies devalue by 30-40%. We then had the dot-com boom and bust, when we had all the telecoms companies go up hugely and then fall. Then we had the global financial crisis, which impacted housing-related stocks and banks. And then we've had the corona pandemic affecting more consumer-related areas such as leisure, transport, travel, hospitality, retail.
Yeah.
You know, the learning for me about this is that we just wouldn't have predicted these in any sort of advance throughout this time. And so my learning is I want to pick companies that can survive these difficult times and thrive ultimately, because we can't predict the future. So I'm looking for companies with what I describe as high barriers to entry. Do they have a competitive advantage that I think can endure and allow them to make money from that for a longer period of time than average? There are 4 business models that I look at for our fund, and this each person can have their own different investment styles, but the particular ones that we look at are lowest cost providers, because we find that when times are tough, people tend to cut their prices. And if you're the lowest cost provider because you have a better technology or a better invested fleet or whatever you do, or geographical advantage, it means that people can't undercut. If you're the lowest cost, they find it very difficult to cut their prices below yours without making a big loss. And ultimately, those kind of companies survive. So businesses like Ryanair and Wizz tend to outperform some of these legacy carriers in tough times because they've got much younger fleets and lower cost bases. Businesses with high levels of intellectual property, so companies that have got brands or patents that protect them from competitors. So some of the drug companies, you can get a 20-year patent on new drug discovery, which prevents competitors from directly competing with the same drug as you. So that's another area that we really like. We love businesses with high levels of very effective sales networks, the ability to optimize selling your product far and wide. And then finally, we love businesses that have high levels of repeat income, companies where they have subscription or long-standing customers who will keep on buying their product come what may. An example of that would be a company like Sage, where they do accounting software. And if you just think about it, and you and I obviously run our business together, as business owners, what do we want to know? We wanted to know foremost who owed us money. And secondly, we wanted to know how much money we had in the bank so we could pay ourselves. And thirdly, we also wanted to know how much we owed the tax man. And because if the tax man suddenly came knocking and we hadn't put enough aside, then we were going to be in a bit of trouble. Now, you don't tend to shift your accounting software provider once you've got one in place, because if you lose sight of all that information, it can be very tricky. So we tend to see in accounting software providers, there's a huge inertia to change. Customers stay with their provider. As long as they keep updating their products, they tend to stay with them for years and years and years. So when tough times come, we've still seen Sage's revenues grow in the first half of this year, and they may have smaller businesses go bust on them, but in general, it's proved to be a very recession resilient business. So that's the 4 models that we look at.
And do those 4 models, are they, is that an approach that you use consistently over the last 20 years, or is it something that's evolved over time to what you're working with now? Have you changed what you've used and the criteria you look at?
I think you're learning the whole time is the most, a lot of people say it, but it's certainly true. And this was a process that I was allowed to put in place when I came to AXA, and they said, look, please manage this portfolio in the way that you think is in the best interest of your clients, which I think is a fabulous thing for any employer to say. And so we put in place the process. But coming back to your question about evolution of investing, just think about it like this. I mean, we learn, I think, the most as investors from our mistakes. And I was thinking about this earlier. The best time to make mistakes is when you're younger. And the best thing to make those mistakes with is your own money rather than the client's money, because it hurts more when it's your own money and it really matters. And for that reason, you'll remember your mistakes. I remember one of the first ever investments I made was in a company that I think I'd done virtually no investment research on, but a couple of colleagues were buying it. This is like the Twitter of today, I guess. You know, someone saying, buy this, and I bought it. I seem to remember it was a cash shell that was they hoped was going to do some decent acquisitions. Didn't happen. I lost a few £100, and I still remember it today. You know, there's a lot of people who are promoting stuff on Twitter these days that, you know, and other people are thinking, oh, I'll just buy that because they seem to know what they're talking about. But don't do that. Do your own research. You know, understand. Some of the best things you can do is get an accounting course, or a very brief one. Understand what the accounts mean, and then also understand what the company does. So yes, that's learning. Mistakes are very important.
Good. And I'm sure you've met a lot of management teams as part of your, you know, your investment approach. What do you think you can learn from, you know, the company management that you can't actually pick up from the numbers that are reported in the accounts?
So that's a good question. You can, you know, as you say, often PowerPoint presentations and company accounts are very dry. You don't really get a sense of the underlying drive of the management team, what they're trying to really achieve. And what are the benefits? You can question them on a face-to-face basis about how their strategy is really going to work. And you can use examples that you've had in the past from your own experience to say, well, I've seen this happen a couple of times and it's never quite worked with other companies. Why are you different? So you've got to ask the questions politely, but I think you've got to ask them firmly. So that's the opportunity to sort of hold their feet to the fire to that extent. But you know, what do I look for in management teams? I'm looking for management teams that are really engaged in what they're doing. Are they just there for a paycheck over the next 3 or 5 years? Or there's a brilliant phrase by Ian Castle, the micro cap club investor, who's written a book called Intelligent Fanatics. And if I could have all of my management teams investing, we've got 37 holdings in the portfolio, and you know, it would be amazing to have 37 intelligent fanatics. And I'll give you one who unfortunately died recently, who I had invested in when I was at BlackRock, but it's Tony Pidgley, the founder of Barclay Group.
Tremendous guy.
And he was an amazing individual, having founded a business which grew up to a FTSE 100 company, best in class margins and returns over most of his period as the MD there. But he used to go into his sites unannounced on a Saturday and a Sunday, and then he'd also go into competitors' sites just to understand what they were doing, what their pricing strategy was. This was a man who was totally fanatical. And I'm going to paraphrase the current managing director, Rob Perrins, badly, but he said that Tony Pidgley was always going to leave in a box from that business. And unfortunately he did, but he was an incredible individual in terms of his fanatical detail in which he would go into for his own business. And if I could find 37 Tony Pidgleys, it would be fantastic.
I'm sure a lot of that comes across in these management meetings, but presumably it's also an opportunity to ask difficult questions. How do sort of management react to those difficult questions that you ask? And, you know, what's your advice on that?
Politeness is the best. It's the best way. I mean, you know, let's be honest. These management teams are, you know, doing their very best, and like fund managers and personal investors, we can get things wrong, and they can get things wrong. And I have been over exuberant in my questioning before, and you know, it feeds back that wasn't appreciated. Sometimes actually when that feeds back to you in the past, that maybe told me something that that management team was clearly feeling the pressure a lot. And in the end, we sold out, and that was a good decision because, they weren't willing to answer our questions, and I kept asking the same questions, not quite Paxton style, but it wasn't well received, and I got feedback pretty stern via the advisors that wasn't appreciated. But
well, I think you've got to ask the difficult questions. I remember when we were had a meeting with Patisserie Valerie about a year after they floated. We had done some analysis that suggested that their store like-for-like sales were going backwards, and we asked them about this, and they got particularly defensive about that. And we left feeling pretty uncomfortable, and fortunately sold the stock. So I think you've got to ask the difficult questions when they come about.
Yeah, definitely, and that's the especially if the answer is very much at odds with what they're saying in other forms of media. So if they're saying, we want to grow in the rest of the world, and yet when you read their report and accounts, it says we're very much keen to grow in our established markets, you're kind of wondering what the mixed message is telling you there. So, there's a lot of companies to choose from, so you can go and find other ones, I think, that would probably fit your investment criteria better. And you can, you need to move on at that point.
Yeah. Should we now have a sort of a look at some of the stocks in your fund? Obviously, it's had some great performance over the last couple of years. It'd be useful to think about some of the companies and some of the holdings you've got there and why they're there. And maybe we could start with something that some people will be familiar with. I know this is in your top 10 and it's performed very well for you, and that's Games Workshop. So maybe you could tell us a little bit about what appealed to you about that company.
Yeah, it's a business that, as you say, is in our top 10. It's just under 7%. And I first looked at it, I think, well, my background is that I remember reading the Dungeons and Dragons manual when I was a youngster, and I couldn't quite understand it. It seemed quite complicated. And I had a passing interest in sort of sci-fi. And I actually remember making some of these miniature figurines, which this is a Games Workshop figurine. It's a
just about to see that, yeah.
There we go. It's a miniature plastic figurine that is used in tabletop wargaming, and people throw dice and play these things. And I had a passing interest in this kind of stuff. So when I was at BlackRock in 2013, I remember it coming up on a screen because I was running some dividend funds then, and it had a dividend yield of 6%, and I couldn't quite see where it was going at the time. And then fast forward to 2017, when you and I were working together, I remember reading an RNS one morning saying sales are ahead of expectations, and I looked back on the numbers now earlier, and it did about 30% plus growth in 2017 in terms of sales, and it's exhibited operating margin growth. And so I thought, okay, that's interesting. So I had a deeper look into it, and it was really interesting in terms of, this is a company that ostensibly has few direct competitors to what it does. I mean, it's a pretty niche-y thing, tabletop wargaming. It sells its products both via the internet, via Warhammer.com, and then also via third-party distributors and its Games Workshop and Warhammer shops. So it's a kind of omni-channel retailer and producer, and it's got 30 years of intellectual property. So it's not only these little miniature figurines which are amazingly constructed, and this one's lost an arm and a gun because it was in my pocket, but it's also the backstories that go with it that allow you to play the game. So the cards that come with this allow people to play the games, tabletop games. And when I looked at it, as I said, very little competition, so that's a great start to what they do. The returns on capital were the other thing that really attracted me. So in 2017, it had £42 million of capital employed in the company, and was making an operating profit of over £30 million. So that's a pre-tax return on capital of roughly 75%. There's very few companies that make that level of return. And so, you know, you add these things up, you've got to, and then finally you read the management report and accounts, and they're written in plain English. They tell you exactly how they make money. They tell you exactly what their strategy is to do for the future. And you sort of add all these things up, and a good dividend yield. So the first thing I did after that was actually I rang the company up and said, could I have a conference call with the FD? And at the time she said, yes, Rachel. So I remember having it in the office when I told you I was working on a bit of client work for you and I. Actually, I was around the corner doing some analysis on
your personal portfolio at the time.
Yeah, and one of the first things I did when I got to AXA in 2018 was to take a colleague up to Nottingham to Lenton, where they've got their HQ, and to visit their big shop and also the manufacturing facilities which we'd arranged. And it was really interesting because you got the real understanding of some of the people there in terms of understanding. You know, I said, but why are these people buying more and more miniature figurines? Because, you know, surely they have enough. And it's interesting when someone turns around to you and said, because they're absolutely fanatical collectors of what we produce. That's a brilliant customer base to be involved in. Someone who really, really wants to buy your products is fantastic. So, you know, that's where we got, and so the shares have just about doubled from the time that first saw them in 2017, and we put them in at just under, or just a smidgen over £30 a share into the fund. So, you know.
Yeah, look, so I mean, they've obviously done very well. Top position in your fund now, I think just over 7%, but you obviously started a lot lower than that. So how do you manage position sizes in a fund? And obviously taught to, you know, run your winners and cut your losers. But there's obviously comes a point in time we've got to manage overall risk. So, you know, have you taken any profits in games workshops, and how do you manage that position sizing in the fund?
So there's a number of questions there, and I'll try and cover them all off. In terms of my overriding priority is where a business is still growing, still exhibiting the reasons why we bought it in the first place. So it still has the attributes. So the return on capital, it has little competition, you know, it has the barriers to entry that we discussed. My inclination is very much to run it, that position. And as I said, we put in just under 3%, and it's now roughly, let's call it roughly 7%. That's the fact that we have actually sold a little bit along the way, badly, is the honest truth. And you know, that's a regret. We don't tend to sell much, but it might have been for a small outflow or something like that. I can't remember the exact reason, but we don't tend to sell much. So that's covering that off. And why do we run our winners, I guess, is a more interesting question. I was reading a really interesting study today by a university professor based in University of Arizona State. And so Hendrik Bessenbinder, if I pronounce that correctly. And he looked at 28-year period and 60,000 stocks on a global basis. And it was interesting that that of those 60,000 stocks on a global basis, over 60% underperformed cash over that period. So, you know, only 40% outperformed cash. And actually, the net growth was from the smallest, the sort of a very small 1% of all companies produced the most amount of market cap growth. And so, I guess what I'm saying here is that, you know, if you can find some really good companies that you think continue to compound and grow over time, you should run them.
Stick with them.
Whereas, you know, we have biases like disposition effect, where this is a tendency to lock in gains because it makes us feel good. You know, we've locked in gains, and we hate admitting mistakes, i.e. we don't like to crystallize our losses as investors. And I'll just give you one example of an old colleague of mine who put in a reasonably significant amount of money at 11p into ASOS. And he had a fantastic return. He made 5 times his money and took it out at 60p. And I texted him just to get my numbers right today. And yeah, the amount of money he left on the table is quite astronomical, in fact. And I'll spare his blushes, but the share price is now £52. So that's a 500 bagger if he kept that in. But no, he made 3.5 times his money. So you only have to have one 500 bagger in your life, and things are good. So look, I prefer to try and run our winners in this fund where we can. There is obviously some risk mitigation that we have. We have 37 holdings in the fund, and we can't have, as a unit trust, we can't have more than 5 of those companies being more than 40% of the portfolio. But aside from that, we let our winners run.
Good. So you're running with Games Workshop for the time being. I've noticed another top 10 holding, which is Integrafin. It's not a stock that I know particularly well, but I see its market cap's about 1.8 billion, and I think the sales are about 100 million. So it looks like a pretty highly rated stock. So I wondered if you could tell us a little bit about that company and what attracted you to it, and why you think it's so highly rated.
Yeah, I mean, it's not a top 10 position. In hindsight, wish it was, because it's done well. But look, this is a business that is a bit like Hargreaves Lansdown, but for wealth managers and for IFAs. They run a platform called TrustNet. Sorry, not TrustNet. Transact. I should apologize. And Transact allows customers or wealth managers to put their clients' money on it. And what's great about this is that it's a lowest cost provider in what it does. So they have invested in the platform. It's the average fee that they charge their clients has fallen from, I think I get these numbers right, from like 40 basis points 4 or 5 years ago down to 28. So they've cut their price the whole time. But at the same time, net assets or assets under advisement on the platform have grown from, I think, 20 billion to over 40 billion. And they've also maintained their cost discipline very well. So what you've seen is an operating margin that has gone up considerably over that time. So you've got a business that they've reinvested into price. They've given their customers a better price each year by cutting price. And yet customers have rewarded them with putting more money onto that platform. So actually their profits have risen quite substantially. And because it's a low capital intensity business, they can pay out a lot of their earnings as dividends and special dividends, which as an income fund, where I'm coming from is finding a business with a sustainable barrier to entry that has growth prospects, which can grow as well as paying us a dividend, which is a great position to be in for companies like that. So that's why that one's done well. And the valuation, I guess my learning over time is that, and come back to my point about ASOS and an old colleague, I don't really sell so much for pure valuation purposes. I tend to sell when the investment case has changed, because good management teams tend to find new avenues for growth. And so if you had sold, let's take an example in the US, Amazon, when it wasn't making money but it was kept on growing, actually you would have made a mistake because the valuation looked high, but it's been the most phenomenal return for that company. And sometimes I think we can be too quick to sell on valuation terms, when actually what we should be saying is, how does this business keep on building on its barriers to entry, growing its business, and ultimately compounding over time.
Yeah. And I see, talking about selling, one of the directors at Integrafin sold some stock last week. How do you react when you see, a director selling? And perhaps more generally, talking about, perhaps you've actually covered it, but about when you sell a stock, when does the stock no longer, when does the stock leave the fund?
Well, the stock needs a fund, Alex, when I sell it. That's, that's the first thing to say. No, I mean, come back to your question. When do we sell? Well, as I said, our primary reason for selling is when the investment case no longer fits or has changed sufficiently that we think that the business model is impeded, and therefore we're looking for another opportunity to deploy the capital. How do I look at investor or insider selling? Well, sometimes they can be selling for a variety of different reasons that we don't know. And if you come back to the Games Workshop example, the original founder of Games Workshop sold shares, I think, at £40. Shares are nudging 95 today. He has sold, and that was like a big chunk. I think it was about £15 million he sold. So, you'd think that he as the ex-founder would know more than everyone else, but in this case, it hasn't been true. He's made a fantastic sum of money, but he, if he'd held on, would have made an even bigger amount of money. So we tend to run, as I said, the winners when they continue to perform and the business model is not impaired. So that's what we do. And when we do feel that we've made a mistake, I think the best thing to do is sell. It's hard because you're admitting that you have made a mistake, and no one likes to do that. But it's often for the best.
Okay. And can we look at maybe some other stocks in your fund that have contributed to performance? What are some names that you'd like to just highlight that have really, helped performance the last couple of years?
Well, as I said, we run an income fund. The one that I manage is an income fund, and there are companies that we have to. We want not only to have capital growth, but we want the dividend alongside it. So we aren't going to have out and out capital growth superstars that many people will have bought. But we do have some businesses, like, as I said, like Integrafin, that's done up over 50% since we bought it, and Games Workshop's done very well. But we've also bought businesses like AstraZeneca, which is in our top 10, which is a business that is a large pharmaceutical company, but the amount of success they're having in terms of rolling out new drugs has really driven their share price well in excess of the bid that was made by Pfizer a number of years ago, 2013 or 14 from memory. So it's about looking for companies where they have an edge, a barrier to entry, and in AstraZeneca's case, they are bringing through some unbelievable medicines which are helping in the oncology space. So cancer, Tagrisso is a particular example, which is annualizing at over 4 billion of sales now, and only came on the market in 2016. It extends people's lives in a very difficult area of lung cancer. I think it's more than doubled progression-free survival. So that's the length of time that you have the cancer and take the drug without the cancer increasing again. So it's giving a lot of people who have got horrible lung cancer a lot of extra valuable time with their families and loved ones. And, the medicines these days are becoming much more personalized. So companies like Glaxo and like AstraZeneca can target specific mutations, such as a BRCA mutation, which the medicines are proved to work better in patients with this specific BRCA mutation. Similarly, in lung cancer, in prostate cancer, ovarian cancer, there's been some massive strides made by by Astra. So drugs such as Lynparza and Tagrisso, as I mentioned, are doing very well. And the reason that it has done well, and we think the likelihood of the dividend growing in the next couple of years begins to improve after not having grown that dividend for a while, is because they've got these medicines which are growing fairly steadily, 10-15% per annum at the moment. So that's a company that's invested in the science. It's got the patent protection that we talked about, so people can't compete against them. And Tagrisso could be, if you look at the Bloomberg forecast, could be a $6 or $8 billion drug in the next couple of years. So growing from its already base of 4 billion. So it's great to see a British company like that doing so well with some excellent science.
And how about some companies that you've been buying recently? Perhaps you could name a couple that you think are particularly interesting, companies that you bought that you think are suited to the current environment.
Well, one that we mentioned in our most recent newsletter is a company called Cls Holdings. We've just started a small position in that, and that's in our newsletter. So I'm not saying anything out of kilter there. It's a company that is over 40% owned by the founder. It's a real estate company in the UK, Germany, and France. Roughly 50% UK, 30% Germany, 20% France. And counterintuitively, it owns offices, and people would think, oh, that's not a nice place to be at the moment, an office owner. Well, actually, I can see at the moment it's not, and that's why the shares are at a 40% discount to their net asset value. But management have shown themselves to be adept at managing these crises, and in the UK, don't forget, only 50% of this business is the UK. Places like Germany and France, we've seen much, much higher levels of return to work. They've got long leases, which companies are still paying. Companies want a head office. They want to collaborate. And I can't wait to get back to the office. I saw that one of the other fund management companies today said they're not going to be sending their people back to the office until June next year. And the thought of a long winter at home, has got some nice bits to it. But I love the ability to discuss very openly with colleagues about companies and not have to sort of go through the whole rigmarole of ringing them up and then they're on a different call. It's actually just that water cooler talk is very important, I think, sometimes to just sorting out, to looking at those little nuances that you may have missed, that they come up with those nuggets.
Yeah. We're just about to, Simon, open up to some questions from the audience. We've had 2 or 3 come in, and I, if you do want to ask a question, there's a Q&A box at the bottom of your screen. Please just type a question in there and we'll try and get through as many of these as we can. But just before we go to that, just a thought or two on, what do you do when you bought a company and it hasn't worked out? What's your approach? Do you add more to it, or do you cut it? Just some thoughts on that before we go to questions, Simon.
Yeah, I mean, the first thing is I tend to write down a thesis as to why I bought a company. And that helps me to come back to it when times are tough. And I will often look at the thesis and see what is occurring in reality at the moment. And if the two don't match up, then you probably shouldn't be adding to the company. For other reasons, the company can just fall because there may be someone who, whatever reason, it might be a fund management company seeing big outflows and they have to sell the position in a difficult market, or they could also be a private investor in a smaller company has taken a big position and just needs to get out because he's getting margin calls. We don't know why that's maybe happening. And in the absence of any news that has changed my investment theory, as it were, investment process. Oh, crap, hold on. What? Oh. Can you hear that? Can you hear all that noise?
Working from home at the moment.
Yeah, hold on, let me just bear me 1 second. Okay.
All sorted. Yes, one of the
All
joys of
sorted.
working
All
from
sorted.
home, many different things.
Yeah. What I was going to say. In the absence of new news, yeah, I might be tempted to add a bit, but I think in general, I try and find out as much as I can about the position, and if I don't want to be pig-headed or stubborn and just add more because I bought the idea and it must be right. Often the best thing to do, if things really have changed, is to change your own mind and sell.
Yeah. Okay. So look, we've had a few questions come in. I'm going to start going through some of these from the audience. Get to see what your thoughts are here. And we've got an investor asking, why invest in a fund when so many of them underperform?
That's a very fair question. On average, funds do, if you look at the data, roughly half the funds outperform, roughly half the funds underperform. But then you take fees into account, and actually slightly more funds underperform than outperform. What you do get as an investor in a fund is that you're getting a full-time fund manager. There are a lot of people who are on Twitter telling you how great their returns are. A lot of those people do that full-time. And so if you haven't got the full-time or the time to devote to investing, and it's not a sort of 5-minute a day job. If you really want to do it well, you need to devote more time to it. If you haven't got that time and you don't have the skills, you can't read the accounts, then yeah, I would definitely think about investing in a fund where the investment process chimes with what you want. And if you can't understand the process they employ, then I would, use a passive product. I think there's any harm in that. And come back to my point about the US stock market and how many companies underperformed and the narrow number that really drove the total performance. It's been very difficult to beat the US market in the last 10 years because of the narrow performance driven by a small number of incredibly high growth companies like Amazon and Google and Facebook, for example. So the average investor, I would say, has probably done a lot worse in the US than they have in other countries.
Okay, moving on to something else here. A topic that you haven't mentioned. Investor asking, do you use technical analysis at all in terms of timing of your purchases or sells?
Tend not to.
No. Okay. That was swiftly dealt with. Next one here. Do you aim for a minimum level of dividend yield? How do you treat special dividends that may temporarily push up a yield? And is that a selling opportunity if the shares run up come dividend?
This always happens. You get the phone calls and you get the noise from outside. The dividend yield that we aim for is equal to or greater than the market. And we are, and then there was special dividend, wasn't it? So we don't mind having companies in the portfolio that pay special dividends out of earnings rather than capital. So what I mean by that is companies that pay it because they've earned surplus capital, surplus cash. And examples of this would be Admiral Insurance, for example, in the motor insurance space. Traditionally, they've always paid a base dividend, and then they've topped it up with a special dividend. They've paid this special dividend. I think they passed on it for about 1 year or 2 years in the last 20, I think. So near as damn it, they've kept on paying the special dividend. Another example would be a company where they sell off a division and they return that capital to shareholders. That tends to be disqualified for dividend purposes because it's more of a return of capital, I should say. So we don't mind companies where they are paying normal plus special dividends out of excess cash flow. We just can't count the ones where they sell off a great big division and return that money to you.
Yeah. Okay. Here's a question for the current times. What stocks do you think might be COVID beneficiaries?
I would almost turn that around and say which stocks aren't COVID, are going to be hit by COVID and try and avoid those, because we don't know how long it's going to last. It's fairly, there's a lot of companies that you wouldn't have thought would have done well that come out of nowhere. And an example I've just mentioned was in the motor space, where Admiral and Sabre Insurance, which we hold in the fund, had announced that because people were driving to work less, and therefore less mileage driven equaled less amount of accidents, and therefore their loss ratios, the amount of money they paid out in motor claims, had fallen. So they actually earned supernormal profits. We've also seen, so that was a sort of what I describe as an unlikely beneficiary. We've also seen a number of companies where trading has suddenly taken off, and I think Games Workshop probably benefited a bit from people staying at home and painting Warhammer figurines. Also, those businesses that could deliver to your door rather than having a fixed shop have obviously been big beneficiaries. But in the biotechnology space, which is not an area that we tend to play in because of these companies don't tend to be profitable yet. A lot of companies are doing some fabulous work there in terms of getting through potentially novel or treatments or diagnostic testing for COVID. And we saw one that we don't own, TT Electronics, saying that they were part of they have an investment in a business where they are going to test for it's a novel test using artificial intelligence for coronavirus, and they're going to supply some of the consumables. The shares did very well on that. So you've got to do your due diligence, have a look around, and I know there's a lot of people talking about who the winners and losers are. We haven't moved our portfolio much. We are pretty long-term, pretty boring in some respects, because we try and find businesses that we think are going to survive the tough times, as I said, and thrive in the good times. So we haven't really moved the portfolio a great deal in the last 6 to 9 months.
Perfect. Well, look, we've got a couple more questions that have come in. I know we've only got a few minutes left, so we'll try and get through all of these. Just a quick one here. What sort of things would be an automatic red flag for a company when you're doing your research, I guess even when you hold a company, what would have to happen? What would be a red flag for you?
Oh, there's a sort of series of red flags you sort of build up a mental armory of these things. And there's a great phrase by Charlie Munger, who's Warren Buffett's associate, and he said, "Tell me where I'm going to die, and I'll make sure I don't go there." And I come back to the mistakes that I've made myself in the past, and it's building up those red flags. Related party transactions tend to be something that has to be investigated. We also look at companies where the financing figures are a bit suspect. That's something, again, you have to dig into. You look at companies where they're saying one thing and doing another. Again, that's a red flag. They don't always completely prevent you from investing, but it definitely puts you on your guard, and it means that you have to do that extra bit of due diligence. What else do we look for? We look for overly promotional management teams, management teams that spend their whole life screaming from the rooftops about how well the business is doing, and yet when you look at the figures, it doesn't seem to be doing that well. Again, another red flag. So there are a number of them. You can even get some of these things automated. So if you look at Stockopedia, for example, they have something called a Benish M score, which gives an indication, but not rather than it's an indicator rather than actual fact that the accounts are being are likely to be manipulated in some certain way. So again, that's something you can always look at on a platform like Stockopedia. And I have looked at that before and occasionally come away with things. Other times it just means that you dig into it and you think, oh, okay, that's the reason why that is. That's fine. I've ticked that off. At least I've done the due diligence, and then you might invest. So like anything in life, you just need to do the work, understand the reasons are behind it, and then make a decision.
Okay. We've got another question in here. It's quite a specific one. You've obviously looked at the property sector and made a purchase in CLS. This is a company about another real estate company, UNI, involved in property development, regional regeneration. Share price is absolutely bombed out, and it trades at a very significant discount to NAV. Directors have sizable holdings, and the recent RNS announcements have been progressively positive, including the recent AGM statement, e.g. planning consents granted, bank covenants, etc. Yet, despite this positive news, the share price remains absolutely nailed to the floor. My suspect is that this question is the person who's asked this question holds the stock and is feeling the pain here. There is currently no dividend, but it's historically paid a good dividend plus special dividends, depending on profits. Is this a company that you've ever looked at? Do you have a view on this? Have you done any research into UNI?
I looked at it a long time ago, but I'm not current on my investment views on that. And just like I said, that any of the companies I've mentioned today, I'm not promoting them. I'm just trying to use them as examples of how we invest. So no is the answer on that. But we've all gone through those difficult periods, and it comes back to that investor look at what they've invested and make your mind up, and I hope it works out for them.
We had sort of one last question that's come in. It's sort of a bigger picture question, really. And do you have any concerns about active management in the face of the growth in the passive management industry? Do you see a future for active management going forward?
Yes, in some respects, I see I like to see it as I am always quite glass half full. Will create opportunity for us that can take a longer term investment decision than some of these passive indices. And so I think it will put, has put pressure on the fees of the whole industry, which, fair enough. This was an industry that has earned good returns. But I do think that the rise of the passives does create opportunity for active fund managers, because the machine goes with momentum, and then suddenly it won't see some of the red flags that we just mentioned. It will just keep buying because it's already a constituent of the index. And unfortunately for those people who are Wirecard shareholders as part of a passive holding in the DAX, that's a difficult thing that those machines won't spot. So I do believe that we have the ability to the future is okay for active management, and there's been some fantastic managers out there who've created some fantastic returns for unit holders, whether it's Terry Smith or Lindsay Train. They have created some really great returns, and so it's difficult for us as fund managers when we see the bad news splashed across the headlines that X, Y, and Z has underperformed badly. I wouldn't mind some of the reporting to be a bit more even sometimes, and I can see why it is, because people, when they're trapped in these funds, do have it difficult. and is their life saving. So I completely understand that, and I don't wish that on anyone. But I would like us to report the successes of some of these really good fund managers and say well done to them.
Well, thank you, Simon, for those thoughts. I think if you continue with your performance in the way you have done for the last couple of years, one of the questions that we came in said it's not a question, but just congratulations on the top decile performance that Simon's had in the last couple of years. If you continue with that, you'll clearly continue to fly the flag for active fund management. So thank you for being with us today. Thank you for sharing your insights. Thank you for everyone for asking their questions and for attending today. Just to mention that our next webinar is going to be on the 14th of October, when we've got management of Hambro Perks EIS fund and management from some of their investee companies, including James Deal of Primary Bid, and they'll be talking about how to invest in early stage growth companies. So that's on the 14th of October. So thank you from me, and Simon, would you like just to say goodbye? And we hope to see you all soon.
Appreciate your time, everyone, and thank you for listening. It was very kind of you to lend your time. So.
Okay, thank you.
Bye-bye.